Okay, so what's the one number investors seem to obsess over when they're trying to figure out if a stock is a total bargain or, well, a bust? It's the price to earnings ratio. In this explainer, we're going to break down exactly what it is, how it can help you, and maybe more importantly, how it can totally trick you. Let's dive right in.
It's really the first question you ask yourself before you even think about hitting that buy button, right? Is this stock cheap or am I about to overpay? For decades, the most popular tool to answer this multi-billion-dollar question has been the PE ratio.
So, what is it really? Put simply, the PE ratio tells you how much the market, other investors, is willing to shell out for each and every dollar of a company's profit. A high PE might suggest investors are expecting big growth ahead, while a low PE could be a sign of a potential bargain. And the math behind it? It's beautifully simple. You just take the current price of one share and divide it by the company's earnings per share. But don't let that fool you. That little E for earnings, well, it can be surprisingly slippery. Things like one-time asset sales or maybe some aggressive share buybacks can totally distort this number. So you really have to know what's going on behind that bottom line.
Okay, now here's where things get really interesting. See, not all PE ratios are created equal, and that's because that E for earnings can come from two very different places, the past or the future. This one little difference splits the whole world of PE analysis into two, and I like to think of it as looking in your car's rearview mirror versus staring into a really foggy crystal ball.
So the trailing PE, that's our rearview mirror. It uses the actual reported earnings from the last 12 months. It's solid. It's based on historical fact. Then you have the forward PE. That's our crystal ball. It uses analysts' estimates of what the earnings will be over the next 12 months. So it's forward-looking, sure, but it's built entirely on predictions, which, can often be wrong. And that brings up a pretty logical question, doesn't it? Since the stock market is always looking ahead, shouldn't we always just use the forward PE? I mean, it seems like a prediction about the future would be way more valuable than a report about the past. Well, it's just not that simple. To even begin to answer that, we first need to understand the single most important rule about PE ratios. They are absolutely useless in a vacuum. A PE of 20 means literally nothing on its own. To make any sense of it, you have to look at the bigger picture, because with PE, context is everything. For instance, a PE of 25 for a utility company, something that grows slowly and predictably, would seem crazy expensive. But that same PE of 25 for a cutting-edge tech firm that's about to explode with growth, that might actually look like a total steal. This is why comparing PE ratios across different industries is such a classic beginner's mistake. And these differences aren't small. They can be absolutely dramatic. Just look at this. The average PE for high-growth semiconductor companies can get close to 50 because investors are betting on all that future innovation. Meanwhile, a more mature industry like auto manufacturing often has an average PE below 10. It's the same market, but they are playing by completely different sets of rules. And it's not just the industry either. The entire mood of the market can shift what cheap even means. During a roaring bull market, optimism is high, and that pushes PE ratios up across the board. But when a recession hits, fear takes over, and suddenly investors aren't willing to pay that premium anymore. The goalposts are always moving. Okay, so with all that context in mind, let's get back to our crystal ball. If the market is so forward-looking, why isn't the forward PSE the perfect tool for the job? Well, the answer is that the predictions it's built on are often deeply, and I mean systematically flawed. See, future earnings estimates are just notoriously unreliable for a few big reasons. Analysts can have an optimism bias, especially when times are good. Companies themselves might sandbag. That's when they intentionally give low estimates so they can easily beat them later and get a nice little pop in their stock price. And on the flip side, a company that's struggling might over-exaggerate how great the future will be just to distract from a bad quarter. And look, this isn't just my opinion. Joachim Clement from the CFA Institute, and these are the folks who set the gold standard for investment professionals. He put it pretty bluntly. Analysts are terrible at predicting company earnings. So, okay, we know the forecasts are a bit shaky, but the real question is, does it actually matter for your portfolio? Does using this flawed crystal ball actually impact your returns? Well, a massive 20-year study looked at exactly that, and the results, they're pretty shocking. The results are just stunning. This 20-year study found that buying stocks with low trailing PE ratios, that's the rearview mirror, actually beat the market by 1.2% every year. But get this, A strategy based on low forward PE ratios, the crystal ball, it underperformed by 1% per year. Following those expert predictions literally destroyed value over time. So the big takeaway here is this. The systematic flaws in those earnings forecasts are so significant that using them as your main value indicator can actually be worse than just using a simple, fact-based number from the past. The rearview mirror, even though it's imperfect, turned out to be a much safer guide than that foggy crystal ball. So, what does all this mean? Should we just throw the PE ratio in the trash? Not at all. It just means we need to use it wisely. It's not some magic number. It's a powerful tool, for sure, but it is just one tool in a much, much larger toolkit for actually understanding a business.
First off, think of PE as a starting point, not the finish line. It's great for a quick first look. Second, always compare apples to apples. A company's PE should only be compared to its direct peers in the same industry. Third, treat those forward PE forecasts with extreme skepticism. And finally, just remember it's only one metric. It needs to be used alongside other tools to get the full picture.
And here's one last critical warning. A low PE is not an automatic buy signal. It can be what's called a value trap, a stock that's cheap for a very, very good reason, like say its business model is failing. Remember, the goal isn't just to buy a mediocre company at a cheap price, it's to buy a great company at a fair price. You know, the PE ratio is such a simple number, but it tells a really complex story. Understanding its flaws is just as important as knowing the formula. It's not a magic bullet, but it is a vital starting point for asking better questions. The real challenge isn't just seeing what a company's PE is, but digging deeper to understand why it is what it is. And now you know exactly how to start finding that answer.